This morning, Brent Crude surged past $70 a barrel, hitting its highest level in 6 months and wiping out a year of stability in a single trading session. This isn't just market volatility. This is a war premium being priced in as the United States and Iran move from diplomatic stalemate to the brink of a naval blockade. With nearly 20 million barrels of oil at risk in the Strait of Hormuz, the world is holding its breath. Today, we break down why your gas prices are about to skyrocket, and the secret energy siege strategy currently unfolding in the Persian Gulf. Visual. Hard cut to title card, bold white on black. The oil shock, why Brent Crude just hit a 6-month high as blockade fears grow. The oil price ticker continues scrolling in the corner. The threat. The Strait of Hormuz choke point. Let's establish the geography first, because understanding the Strait of Hormuz is essential to understanding why a 4% spike in oil prices is not just market noise. It is a rational response to a genuine supply risk. The Strait of Hormuz is a 21-mile-wide waterway at its narrowest point. It connects the Persian Gulf, where Saudi Arabia, Kuwait, Iraq, the UAE, and Iran all have major oil export terminals, to the Gulf of Oman, and then to the Indian Ocean and global shipping routes. There is no alternate route. There is no pipeline that can replace the volume. If you want to get oil out of the Persian Gulf by sea, you go through the Strait of Hormuz. There is no other option. Approximately 21 million barrels of crude oil and petroleum products pass through the strait every single day. That represents roughly 20% of the world's total oil consumption. For context, the United States consumes about 20 million barrels per day. The entire European Union consumes about 13 million barrels per day. The Strait of Hormuz, on its own, moves more oil than the EU uses. This is what energy analysts call a choke point. Not in the colloquial sense of something important. In the technical sense, a geographical feature so critical to the global supply chain that its disruption would cause immediate, cascading failures across multiple sectors and economies simultaneously. Daily oil transit, Strait of Hormuz. 21 million barrels a day. Percentage of global crude supply, 20%. Percentage of seaborne oil, 30%. Tuesdays, security precautions. The temporary closure. On Tuesday, February 17th, the same day that the Geneva talks collapsed, Iran's Ports and Maritime Organization issued what they described as security precautions for the Strait of Hormuz. For several hours, commercial shipping through the strait was halted. Not banned, not blockaded, just stopped. Iranian naval vessels positioned themselves in the shipping lanes. Tankers were told to hold position and await clearance. The official explanation from Tehran was that the IRGC Navy was conducting unscheduled exercises, and that the temporary closure was necessary for the safety of civilian vessels. The closure lasted approximately 4 hours. Then, as abruptly as it began, it ended. Tankers were given clearance to proceed. The lanes reopened. The backlog began to clear. 4 hours. That was all it took. And yet the impact on global energy markets was immediate and measurable. Brent Crude, which had been trading at approximately $67 per barrel on Monday, jumped to $68.50 by Wednesday morning, before the full extent of Tuesday's closure was even confirmed. Traders were not reacting to the 4-hour disruption itself. They were reacting to what the disruption signaled: Iran's willingness to use the strait as a weapon. Because here is the critical point about choke points. They do not need to be closed permanently to cause catastrophic damage. Even a temporary closure, even a few hours, creates a backlog that takes weeks to clear. Tankers miss their scheduled delivery windows, refineries run short on crude, gasoline inventories at distribution terminals drop below operational minimums, prices spike, not because there is an actual shortage, but because the market is pricing in the risk of future shortages. This is the vulnerability that Iran understands and that energy markets are now pricing in. The Strait of Hormuz does not need to be blockaded for months. It does not need to be mined or destroyed. It just needs to be disrupted, repeatedly, unpredictably, and the global energy system begins to fracture. Warning. Even a 48-hour closure of the Strait of Hormuz would remove approximately 42 million barrels from the global supply chain, equivalent to 2 full days of world oil consumption. The price impact would be measured not in single-digit percentage increases, but in potential doubling of crude prices within a week. The intelligence. Why Wednesday's 4%? Spike. Geneva failure. Plus, China blockade reports. Let's talk about timing, because the 4% surge in Brent crude prices on Wednesday morning, February 19th, did not occur in a vacuum. It was the product of multiple converging factors, all of which became public knowledge within a 48-hour window. Factor 1, the Geneva talks collapsed on February 17th. That was confirmed publicly. The U.S. delegation walked out. Iranian Foreign Minister Abbas Araghchi held a press conference where he tried to spin the outcome as constructive, but no one was buying it. The diplomatic track had failed. That meant the military and economic tracks were now the only options remaining. Factor 2, Tuesday's temporary closure of the Strait of Hormuz. As discussed, this was a signal, a demonstration, a reminder that Iran has the capacity to disrupt global energy flows anytime they choose. But factor 3, the factor that traders reacted to most strongly, was something that did not make headlines in the mainstream press, but that circulated widely through energy trading networks and financial intelligence services on Tuesday night and Wednesday morning. The intelligence gap, U.S. to Israel, weeks-long campaign to zero out Iranian exports. According to multiple sources who spoke to Reuters, Bloomberg, and the Wall Street Journal between Tuesday night and Wednesday morning, sources described as officials familiar with U.S. and Israeli military planning, the United States and Israel are coordinating a weeks-long campaign designed to eliminate Iran's oil export capacity entirely, not reduce it, not sanction it more heavily, eliminate it. The campaign, according to these sources, has two components. One is kinetic, military strikes against Iran's oil export infrastructure, primarily the Karg Island terminal, which handles approximately 90% of Iran's crude exports, and the refinery complexes at Abadan and Bandar Abbas. The other component is financial, using a combination of enhanced sanctions enforcement, naval interdiction of shadow fleet tankers, and diplomatic pressure on China to finally stop purchasing Iranian crude. This is not a leak, this is deliberate signaling. When multiple senior officials speak to multiple major news organizations within a 12-hour window, all delivering the same message, that is coordinated messaging. The US and Israel want the market to know that this campaign is being planned. They want Iran to know. And they want China, Iran's primary customer, purchasing roughly 90% of Iran's current oil exports, to understand that continuing to buy Iranian crude is going to become significantly more expensive and legally risky in the very near future. Energy traders heard this reporting and immediately began pricing in the scenario. If Iran's 3 million barrels per day of exports are removed from the market, and if that removal happens quickly, without time for other producers to ramp up compensatory production, global oil inventories, which are already projected to decline by 6 million barrels over the next quarter, would enter what analysts are calling a critical deficit. A critical deficit is the point at which demand consistently exceeds supply and inventories drop below the operational minimums required to buffer the system against short-term disruptions. Once you enter a critical deficit, price volatility becomes extreme. A refinery shutdown in Texas, a pipeline break in the North Sea, a storm in the Gulf of Mexico, any of these routine disruptions, which would normally be absorbed by drawing down inventories, instead triggers immediate price spikes because there's no buffer left. Not the current supply-demand balance, which is tight but manageable. The future balance if the U.S.-Israel campaign proceeds as reported. On Wednesday morning, today, February 19th, Iran's civil aviation organization issued a NOTAM, a notice to airmen, for rocket launch operations over southern Iran. The NOTAM covers the Bushehr province region, which includes the Karg Island oil terminal and several major offshore oil platforms. NOTAMs are routine. Every nation issues them when conducting military exercises, rocket tests, or other activities that could pose a hazard to civilian aviation. Bushehr province is Iran's primary oil export zone. Karg Island, located just off the coast, is the single most critical node in Iran's energy infrastructure. Issuing a NOTAM for rocket launches over this area on the same day that oil prices are spiking due to blockade fears is a signal. It is Iran demonstrating that they are actively preparing their defensive and offensive capabilities in the region where any U.S. strike would almost certainly target. Rocket launches could mean ballistic missile tests. They could mean air defense drills. They could mean positioning of anti-ship missiles along the coastline. The NOTAM does not specify, and it does not need to. We are positioned, and if you strike our oil infrastructure, we will respond. Energy markets heard that message loud and clear. By midday Wednesday, Brent Crude had broken through $70 per barrel, a psychological resistance level that traders had been watching for weeks. The breach of $70 was not just a price move. It was a signal that the market believes the risk of a full-scale energy disruption in the Persian Gulf is no longer hypothetical. It is imminent. INFO, NOTAMs are publicly available through the International Civil Aviation Organization ICAO database. Analysts and traders monitor these closely for early indicators of military activity that may impact energy infrastructure or shipping routes. The tech breakdown, the financial blockade versus the kinetic strike. Let's break down the strategy that is currently being executed, because understanding the mechanics is essential to understanding why oil prices are moving the way they are. The United States has two primary tools for eliminating Iran's oil export capacity. One is financial, one is kinetic. Both are being prepared. Both can be deployed independently or in combination, and the market is pricing in the possibility that both will be used. The physics of the surge, supply-demand delta, start with the baseline numbers because they matter. Global oil demand in 2026 is projected at approximately 102 million barrels per day. Global supply is projected at approximately 101 million barrels per day. That is a deficit of 1 million barrels per day. Not catastrophic on its own, inventories can absorb that for months. But it means the system has no slack. There's no surplus production sitting idle that can be brought online quickly if a major producer is removed from the market. Iran currently exports approximately 3 million barrels per day, almost all of it to China. If those exports are eliminated, whether through a financial blockade that makes it economically unviable for China to continue purchasing, or through a kinetic strike that destroys the export infrastructure, the global supply-demand balance shifts from a manageable 1 million barrel per day deficit to a critical deficit of 3 million barrels per day. 4.3 million barrels per day is not a number that can be compensated for quickly. Saudi Arabia has spare production capacity of approximately 2 million barrels per day. The UAE has maybe another 500,000. The United States, through increased shale production, could potentially add another million barrels per day over a 6 to 12-month period. But that still leaves a gap. And crucially, it takes time. Months, not weeks. During that time, the period between when Iranian exports are removed and when compensatory production comes online, the market will be in acute shortage. Inventories will draw down rapidly. Prices will spike. And every economy that is heavily dependent on imported oil will feel the pain immediately. Current global oil deficit, 1 million barrels tossed day. Iranian exports at risk, 3 million barrels, Dr. day projected critical deficit, if Iran removed. 3 million barrels day. The command, Executive Order 13846, Enforcement TUS. AI Satellite Tracking Executive Order 13846, signed by President Trump during his first term in 2018, reimposed comprehensive sanctions on Iran's energy sector. It prohibits any entity, or foreign or domestic, from purchasing Iranian crude or providing services related to the Iranian oil industry. Violations can result in secondary sanctions, which means that any company or financial institution that facilitates Iranian oil sales can be cut off from the U.S. financial system. For years, enforcement of Executive Order 13846 was inconsistent. Iran developed an elaborate shadow fleet, a network of aging tankers, often reflagged under obscure registries, that would load Iranian crude at offshore terminals, turn off their GPS transponders to avoid satellite tracking, and deliver the oil to Chinese ports that were willing to look the other way. At its peak, this shadow fleet was moving close to 2 million barrels per day, effectively evading sanctions through a combination of physical obfuscation and diplomatic tolerance from Beijing. But over the past 6 months, enforcement has tightened dramatically. The reason? AI-driven satellite tracking. Commercial satellite companies, Planet Labs, Maxar, Capella Space, and others now provide near-continuous coverage of the Persian Gulf and the key shipping routes out of the region. Their satellites capture optical imagery, synthetic aperture radar, and even infrared signatures that can identify tankers even when their transponders are off. The U.S. Treasury Department has contracted with several of these firms to use artificial intelligence to analyze the satellite data and identify vessels that are likely part of Iran's shadow fleet. The AI systems look for patterns. Ships that loiter near Iranian offshore terminals, ships that suddenly go dark for days at a time, ships that appear in Chinese ports with no clear record of where they loaded their cargo. Once a vessel is identified, it is added to a sanctions list. Any company that does business with that vessel, the ship owner, the insurer, the port operator, becomes subject to secondary sanctions. This is not a perfect system. Iran continues to move oil, but the volume has dropped significantly. According to tanker tracking data from K-Peeler and Vortexa, 2 firms that specialize in energy logistics intelligence, Iranian crude exports have fallen from approximately 8 million barrels per day in mid-2025 to 3 million barrels per day as of February 2026. That is a drop of 500,000 barrels per day, representing billions of dollars in lost revenue for Tehran. And the enforcement is accelerating. The Treasury Department has added over 200 vessels to its sanctions list since the beginning of 2026 alone. The message to ship owners is clear. If you work with Iran, you will be identified and you will be sanctioned. The counter, the tariff torpedo. 25% on Iranian crude buyers. But sanctions enforcement alone is not enough, because China has been willing to absorb the secondary sanctions risk in order to maintain access to discounted Iranian crude. Iranian oil sells at a significant discount to market rates, sometimes $10 to $15 per barrel below Brent because of the sanctions risk. For China, which consumes over 15 million barrels per day and is constantly looking for ways to reduce its energy import costs, that discount has been worth the risk. The Trump administration's answer to this calculation is what is being called, in energy trading circles, the tariff torpedo. The proposal, which has been discussed in classified briefings but has not yet been formally announced, is to impose a 25% tariff on any country that continues to purchase Iranian crude after a specified deadline. The tariff would apply not just to oil imports, but to all goods imported from that country into the United States. This is an extraordinarily aggressive trade measure. It effectively weaponizes U.S. market access to enforce energy sanctions, and it is aimed squarely at China. China exports over $500 billion worth of goods to the United States annually. A 25% tariff on all of those goods would represent a $125 billion cost to Chinese exporters and U.S. importers. That is an order of magnitude larger than the value China derives from purchasing discounted Iranian oil, which is maybe $10 to $12 billion annually. The logic is simple. Make it more expensive to buy Iranian oil than it is worth. Force China to choose between access to the U.S. market and access to Iranian crude. And if China chooses the U.S. market, which economically they almost have to, then Iran's oil exports collapse entirely. This is the financial blockade strategy. No bombs, no cruise missiles, just economic pressure, precisely targeted, designed to make Iranian oil exports economically non-viable for any buyer. Whether it will work is an open question. Whether it will be implemented is also an open question. But the fact that it is being discussed, the fact that senior administration officials are leaking details to the press, is itself part of the strategy. It is a signal to China. This is coming. Adjust your behavior now or face the consequences later. Warning. The tariff torpedo, if implemented, would likely trigger immediate retaliation from China in the form of counter-tariffs on you. S goods, restrictions on critical mineral exports, or other economic measures. The risk of a broader U.S. and China trade war is significant. The geopolitical so what? The election year gamble, high prices, there's maximum pressure. Here is the political dilemma that the Trump administration is navigating right now, and it is a genuine dilemma with no clean solution. High oil prices are politically toxic. Americans notice gas prices. They notice them every time they fill up their tank. They notice them when they see the receipts at the grocery store, because higher fuel costs get passed through to transportation costs, which get passed through to food prices, which get passed through to consumers. What will sustain $10 to $15 increase in crude oil prices translates roughly to a 25 to 35 cent increase in gasoline prices at the pump. That adds up fast. In an election year, and 2026 is a midterm election year with control of Congress at stake, rising gas prices are a gift to the opposition. Every time a voter fills up their tank and sees $4, 50 per gallon instead of $3, 50. That is a reminder that the current administration's policies are making their lives more expensive. It does not matter if the administration can explain why the prices are rising. It does not matter if the long-term strategic goal is to eliminate Iran's nuclear program and prevent a regional war. What matters is the price on the LED board at the gas station. This is the political cost of maximum pressure. If the administration proceeds with the financial blockade or the kinetic strike, if they successfully eliminate Iran's oil exports, the immediate result will be higher energy prices globally. That includes the United States. That includes swing states. That includes voters who are already frustrated with inflation and cost of living increases. But here's the other side of the dilemma. Backing down is also politically costly. If the administration signals that it is willing to tolerate Iran's nuclear program in order to avoid an oil price spike, then every foreign policy hawk, every pro-Israel constituency, every voter who believes in American strength and resolve will ask, what was the point of all the rhetoric? What was the point of the carrier deployments, the ultimatums, the collapse of the Geneva talks? This is the election year gamble. Proceed with maximum pressure and accept the political cost of higher energy prices. Or back down, accept the political cost of appearing weak, and hope that voters prioritize foreign policy credibility over gas prices. Can the SPR offset the shock? One potential tool the administration has is the Strategic Petroleum Reserve, the SPR. The SPR is a system of underground storage caverns along the Gulf Coast that holds emergency crude oil reserves. It was created after the 1973 oil embargo to provide a buffer against supply disruptions. At its peak, the SPR held over 700 million barrels. As of February 2026, it holds approximately 350 million barrels, still substantial, but significantly drawn down from previous releases during the 2022 energy crisis and subsequent refilling efforts. If oil prices spike due to the removal of Iranian exports, the administration could authorize a release from the SPR. say 1 million barrels per day for 60 or 90 days, to flood the market with additional supply and dampen the price increase. This is textbook crisis management. It is exactly what the SPR was designed for. But there are limits. The SPR can provide short-term relief, but it cannot replace 3 million barrels per day of Iranian exports indefinitely. Eventually, the reserves run low. Eventually, they have to be refilled. And refilling them means buying oil on the open market, at whatever the market price is at that time, which could be significantly higher than it is today. The SPR is a buffer, not a solution. It can buy time. It can smooth out the worst of the price spike. But it cannot eliminate the fundamental supply-demand imbalance that removing Iranian exports would create. Will the blockade force China to stop backing Iran? The other variable, the one that could fundamentally change the entire equation, is China. China is Iran's economic lifeline. Beijing purchases approximately 90% of Iran's oil exports. Without that revenue, Iran's economy collapses. The government cannot pay IRGC salaries. They cannot subsidize fuel and food. They cannot maintain the patronage networks that keep the regime stable. Chinese oil purchases are not just an economic transaction. They are the foundation of Iran's ability to survive under sanctions. But China is also deeply integrated into the global economy. They export to the United States, to Europe, to every major market. A 25% tariff on Chinese goods, the tariff torpedo, would devastate key sectors of the Chinese export economy: electronics, machinery, consumer goods. The pain would be immediate and severe. So the question is, will China choose Iran or will they choose market access? The Trump administration is betting that China will choose market access, that when faced with the reality of losing $125 billion in annual exports to the U.S., Beijing will cut Iran loose. They will stop buying Iranian oil. They will stop providing diplomatic cover at the UN. They will let the regime in Tehran collapse under the weight of its own economic failures. If that calculation is correct, then the financial blockade works. Iran is isolated, economically strangled, and forced to accept U.S. terms. The oil price spike is temporary, maybe a few months, and then compensatory production from Saudi Arabia, the UAE, and U.S. shale fills the gap. The market stabilizes. The crisis ends. But if the calculation is wrong, if China decides that maintaining its strategic partnership with Iran is worth the economic cost, or if Beijing calls the U.S. bluff and refuses to comply, then the financial blockade fails. Iranian oil continues to flow. The U.S. is forced to either back down or escalate to kinetic action, and the entire strategy unravels. This is the high-stakes bet at the center of the current crisis, not just whether the U.S. can eliminate Iran's nuclear program, but whether it can do so without triggering a trade war with China, a permanent rupture in U.S.-China relations, and a prolonged period of energy market instability that damages the U.S. economy in an election year. Here's the board. 2 critical items to watch over the next week. Watch item. Item 1. The Tengiz field reopening, Feb 23. The Tengiz oil field in Kazakhstan, one of the largest oil fields in the world operated by Chevron, has been operating at reduced capacity since mid-January due to maintenance and equipment issues. The field normally produces approximately 700,000 barrels per day. It has been producing closer to 400,000 for the past month. Chevron has announced that full capacity will be restored by February 23rd. If that timeline is met, 300,000 barrels per day of additional supply will enter the market, providing modest relief to the current supply deficit. But if the reopening is delayed, if technical issues persist, if the timeline slips by even a few weeks, then the supply gap widens further. The market is already tight. Every 100,000 barrels per day matters. Watch the Tengiz reopening. If it fails to meet the February 23rd target, expect oil prices to surge further. Watch item 2, Brent resistance. At $72, technical analysts who follow energy markets are watching one specific price level, $72 per barrel for Brent Crude. This is what traders call a resistance level, a price point that has historically been difficult for oil to break through. In the past 2 years, every time Brent has approached $72, it has either stalled or pulled back. The market treats this level as a psychological barrier. If Brent breaks through $72 and sustains above it by Friday night's close, February 21st, that is a signal that the market believes the energy disruption is not temporary, it is structural. And if traders believe that, they will price in even higher future prices. Watch the $72 level. A sustained break above it means we are entering what energy analysts call an energy emergency phase, a period where prices are driven not by normal supply-demand dynamics, but by fear of catastrophic supply disruption. Current, $70. 12. Watch, $72. Resistance. In 2026, the most expensive thing on Earth is not gold, it is not rare earth minerals, it is not cutting-edge semiconductor technology. It is the cost of a ship that cannot get through the Strait of Hormuz. That sentence encapsulates the entire energy crisis currently unfolding. The Strait of Hormuz is not just a geographical feature. It is the linchpin of the global energy system. 21 million barrels per day, 1/5 of the world's oil, moves through that 21-mile wide waterway. And right now, the ability of tankers to transit that strait without disruption, without delay, without the threat of Iranian interdiction, is being called into question. That is why Brent Crude hit $70 per barrel this morning. Not because there is a current shortage of oil. There is not. Inventories are adequate. Refineries are operating normally. The physical supply chain is functioning. But the market is forward-looking. Traders are not pricing today's supply-demand balance. They are pricing the risk of tomorrow's balance. And tomorrow's balance, if the U.S. proceeds with the financial blockade or the kinetic strike, looks very different. Iranian exports, 3 million barrels per day, are at risk. The Strait of Hormuz, 21 million barrels per day, is at risk. The entire Persian Gulf export infrastructure is at risk. And the market, seeing these risks, is pricing in a war premium. This is not speculation. This is not irrational market behavior. This is rational actors, operating with imperfect information, making their best estimate of what the probability-weighted outcome looks like, and deciding that the probability of a major supply disruption is high enough to justify paying $70 per barrel today, rather than waiting and potentially paying $90 or $100 per barrel next month. The administration understands this. They know that every dollar increase in crude oil prices translates to political pain at the ballot box. They know that voters will blame them for high gas prices, regardless of the geopolitical rationale. And yet they are proceeding anyway, because the alternative, allowing Iran to complete its nuclear program, accepting the legitimization of a heavily enriched uranium stockpile, signaling to the world that the United States will back down when the cost gets too high, is also politically and strategically unacceptable. So here we are. Oil prices spiking, carriers deploying, the Strait of Hormuz under threat, and the global economy waiting to see which breaks first, Iran's will to resist or the market's tolerance for energy uncertainty. We will know soon. The Tengiz field either reopens on schedule or it does not. Brent either breaks through $72 or it does not. The Geneva deadline passes, and Iran either returns with an acceptable proposal or they do not. And if the answers to those questions are all negative, if the supply tightens further, if prices break higher, if diplomacy remains deadlocked, then the energy siege becomes not a strategy but a reality. And the world finds out just how fragile the global energy system really is when a single waterway, 21 miles wide, becomes a geopolitical battlefield. Subscribe for daily updates. As oil markets react to Iran crisis, will Brent break 72? Drop your price. Prediction below. Production. Notes for editor. Hook. 0:00:45. The threat. 0:45. 4 an hour. Intelligence. 4:0. Tech breakdown. 10:18. Geopolitics. 18:24. Conclusion. 24 and all B-roll. Charts and visual cues marked in line in visual brackets. Critical. Oil price ticker must be persistent throughout. Position in upper right corner. Update with live delayed pricing data. Red for increases. Green for decreases, if any. Key visuals. Trading floor footage. Gas station price boards. Strait of Hormuz map with tanker routes. Bloomberg terminal screens. Carrier operations. NOTAM document graphic. SPR facility exterior. China, U. S trade flow diagram. Tone. Analytical and economic focused. This is about markets, supply chains, and the intersection of geopolitics and energy. The audience should understand both the immediate price moves and the deeper strategic dynamics driving them. Use market data, not military drama, as the primary narrative driver.